In this lesson, we're talking about pivots. We're going to discuss what they are, the importance of pivots, why we use them, and of course, how we use them. The most important aspect of a pivot is that it's the chart's way of telling us that a certain price level is important. The charts always have a story to tell. It's our job to be able to interpret that story. If you can interpret that story correctly, that's a recipe to make money in the market. Pivots can come in different forms. I like to classify them as minor pivots and major pivots. As an example, here are two minor pivots. They're pivots because the market traded to a certain level and went in the other direction. In the pure definition of a pivot, it's still valid. However, it's not a major pivot. What we're really concerned with are major pivot points. However, let's take a look at why these were pivots and what caused them to be pivots. You'll recall consolidation pattern. These are two consolidation patterns. The market made a move downward, consolidated, getting ready for another move or a continuation move. Now, there happened to be two consolidation patterns before the final move down, but they're still consolidation patterns nonetheless. Once a consolidation pattern is formed, it will act as either a resistance point or a support level in the future. Why is that? Because when the market trades to a specific level and then consolidates or goes sideways for a while, that's the market's way of letting you know that that price level where it stopped and began to consolidate is important. That price level was important to the market. If a price level is important to the market, it will remain important to the market. Therefore, the next time the market visits that price level, it has a high likelihood of acting as either a resistance point or a support level, depending on which way the market's going. If the market's going down, it will be a support level. If the market's coming up, it will be a resistance point. So when the market found a short-term bottom and began to reverse, the next natural area of resistance is a former consolidation pattern. So the fact that that consolidation pattern was there, when the market traded up to it and reversed, it created a pivot. We traded up to the consolidation pattern. The consolidation pattern acted as resistance, and therefore the market, at least on a short-term basis, reversed trend. This case, it's a minor pivot. The best way for you to understand the difference between a minor pivot and a major pivot is to wait until we go over a major pivot, and then the distinction will be very clear. When the market found another interim bottom, it reversed the short-term trend again, and what happened? It traded right up to the former pivot. And that former pivot acted as another resistance point, which is also at the same level of the consolidation pattern that created the first pivot initially. Why does this happen? Because the market is telling you that the price level in here is important. How does the market get through an important price level? Very simple. It consolidates either underneath or at that important price level or former consolidation point in order to get through it. Well, what do we have here? What we have is a longer term consolidation pattern building energy to get through it and go higher. That is another consolidation pattern building energy to get through the former consolidation pattern. And that's the way the market works. When a market wants to get through a specific price level, it's not uncommon for it to go up to that price level and test it a few times before finally breaking through. And that's really what these two pivots were. They were testing that price level, were rejected a couple of times, until the market consolidated for long enough in order to build up enough energy to go higher. Now, these aren't big moves by any stretch. However, the concept holds true whether they're big moves or small moves. A market will find a specific price it deems important. It will stop at that price. A lot of times it will consolidate if it's going to have a continuation move. And then on the way back, the market's going to find resistance or support at that level again. And if the market wants to move through that level, it consolidates and it builds up the energy to get through the level, and that's precisely what we saw. You'll find these patterns repeated over and over and over again throughout the market. Consolidation patterns happen each and every day, whether you're looking at the ES contract, whether you're looking at another commodity contract like gold or oil, or whether you're looking at a stock. It doesn't matter. Consolidation patterns happen on every chart. That's specifically how the market trades. Let's take a look at what major pivots look like. Now that is a major pivot because the market traded to that level and changed direction, but went in a different direction in a much larger way than we just saw. The way we can use pivots like this into the future is when the market does come back to this price level, there's a very high probability that it will become a resistance point in the future. And we can use that information in two ways. If, for example, we're in a trade and we're long the market, meaning we've bought the market, it's trading higher, we need to understand where to exit the market. Former pivot points will be good exits. If the market is coming up to a pivot, that's a good exit. If we're short the market and the market is coming down to a former pivot, that's also a good exit. Pivots like this one can also act as a good entry point. If the market is trading up to this pivot, there's a high probability that the market will find resistance at that pivot and trade lower. It may not trade lower to this magnitude, but there's still a high probability that the market will be rejected, even if it's for a temporary or short period of time, providing at minimum of a scalp trade opportunity. Let's find another example of a pivot. This is a very obvious area on the chart where the market traded up to a specific point and turned on a dime, heading in the other direction, creating a well-defined pivot. When the market comes back to this level, there's a high probability we will find a resistance point at that level. And just like before, on a short-term basis, the market found a particular low here, and what happened the first time that we came back to test that level just a little while later? That pivot acted as support. Just so happens that that candle is a doji candle, which is a signal of a trend change into a former pivot, a potential opportunity. You can see how each and every component that we discuss builds on the next one, and we're able to put them all together so that we can fully understand what's happening on the charts, and we begin to understand how to expect certain things to happen on the charts. Sometimes the market will come back to test a pivot on a very short-term basis, and sometimes it's on a very long-term basis. Let's take a look at a longer-term chart and see pivots work in action. Here we're using a 60-minute chart, and we have a pretty well-defined pivot high. So let's put a line on the chart that spans the entire chart, and let's see if the market thinks this price level is important. So let's go back in time to see if this price level was important and why the market would have stopped at this price level right here. Let's just roll back the clock a little bit and see what the market thought of this price level. So you can see we traded around it. We stopped at this pivot, traded through it a little bit, back and forth, but the market was consolidating around this price level. That's what all this is. Let's keep going and see why this price level might have been important. The market traded up to it, slightly above it a little bit, but certainly failed. Price level is important. Here's another area where there was a pivot. It's a former pivot. Price level is important. Let's keep going. Here the market traded through it a little bit, came back to it. Price level is important. Look at all these pivots. We have 1, 2, 3, 4, 5, 6 pivots right there. Market thinks this price level is extremely important. When we know that a price level is important because of prior market activity, we want to be aware of that price level into the future. And that is the exact reason why the market found a resistance point at this level around 2140. You've all heard the term, history repeats itself, and the market is no different. History repeats itself throughout the markets, and if we can accept that, then we can use history to our advantage about what might happen in the future. When the market trades to a certain price level and reverses in the other direction, it creates a pivot. It creates the pivot because the market is telling us that price level is important. That's something we want to be aware of and can certainly use to our trading advantage.